Hey guys, still in the deserts of Sedona. It's June the 28th, 2 days to month end. As per usual, exciting day in the markets. Let's take a look at what is going on. Okay, when we look at the indices, again, you've got everything in the red, even though it started in the green. And part of that is because we kind of know what's coming up on the economic front. I'm going to go through the economics, a few different data points, and really, like I said, the whole strategy through the summer until we get into earnings season, which won't start until the middle of July, but really will be in full swing those last weeks of July, August, before we then take off for summer vacation in Europe. But there's just not like this is about accumulating long-term names, and then accumulating what you might want for the back half of the year, more so than investing and being all upset that something's happening. And you really want to, for that reason, just take opportunities where you can, and you know, kind of pick your spots for the long term of investing. If you're a day trader, though, it's still your market, and that's why I always say positive things about my colleague Richard, because he must be just having the best time of his life. He does our early morning 9:30 show. Okay, here's what the market looks like today, though, on a name by name basis. At one point, these were up and now they're down and they'll be up again. And it's just kind of this yo-yo effect that we're having because there really isn't any news flow. It's just macro and people repositioning. Energy on the positive today. In some cases, I went ahead and took some profits just so that I could get the theta out. And I think we'll probably have a couple of yo-yos before the end of the day. But there is some news here that I want to share with you on Berkshire Hathaway. If you guys see my Instagram, Markets with May, you'll notice I made a little meme, but I'm still getting good at I'm still getting used to how do you replace one face with another. The Oxy deal is a good one, and him taking further ownership there just makes sense. We continue to like Devon because the dividend yield is hella high and it's not going to change. And there's nothing that is changing in the energy market, at least in the next 2 years, that won't be anything but bullish. And that's even if we get resolution overseas. So just realize that's the state of affairs right now. And that kind of is what it is. But then let's get into kind of the economic data that came out today. Again, we said past performance, not indicative of future returns. Sometimes we're going to say that. But, you know, it's interesting because everybody honed in on the Richmond Fed president commentary, which I swear in my entire career, no one has ever cared about that number. I'm just going to say it like it is, because there are just so many better numbers to try to give you the data points related to anything going on as relates to it. So that's a little bit crazy to me. I'm not sure why the market got overly excited. What they really should have paid attention to was consumer confidence, which does actually matter. That index in particular matters a lot because really it's all about what's going on with consumer. Similarly, even the home price index would have mattered more. We're getting all-time high there. So let me just show you what I saw there. With consumer confidence, actually, despite the fact that this came in a little bit worse, in my mind, this is way better than I would have expected, which tells you the consumer is not as weak as folks think. Now, a lot of folks honed in as well on the Nike news this morning. I'm going to go through that in just a sec, but these are data points that we're getting on consumers. Now, this is the home price news, surged to another record high. I don't know. Oh, yeah. So it's the June number. June dictates what happened in April. So even though everybody's talking all this talk about pricing, right? The fact is that the timing, so you know, the April numbers come out in June. Next month will be May. So you can kind of gauge that as relates to where interest rates are. And realize too, and people forget this all the time, you know, you have to kind of, if you're trying to buy a house and you think rates are rising, you want to lock in the cheaper rate. So if you think it's going to be trending rising for a while, it actually ends up helping, not hurting home sales. And so I was listening this morning to the folks, you know, I really wonder if all of these talking heads even bother to read press releases, let alone actually listen to the calls, because they were talking about all these things like builds and how these guys overbuild and they're all building like crazy. That's malarkey. Let me just tell you now, for the last 3 quarters, not even just 2 quarters of this last quarter, the last 3 quarters, every home builder has told you that they are slowing down build, not because they thought there wasn't demand. They saw plenty of demand. Don't get me wrong on that at all. They just weren't going to build it because they were going to make the same stupid mistakes they made in 2008. Every single home builder in large cap land, Lennar, Pulte, DR Horton, said it. Now, if the smaller home builders are doing that, I can't really speak to that. As you guys know, I watch the S&P 500 like a hawk. I can't really speak to the other names, but those large builders do represent a lot of home build. Additionally, I'm just going to say it one more time. Within multi-family REITs, apartment REITs, residential REITs, not seeing a slowdown in rents. Everybody's able to increase rents, and that has to do with what we're seeing in labor. So this idea, so like all I'm really seeing is that like I'm vindicated on what I'm saying as far as things go, and that thus far what the and you know, it's not like I'm particularly clever. I'm not. I'm literally regurgitating what these CEOs are saying consistently across not just their field. All of the CEOs are saying the same thing within their field, but also within across industries. So the real estate investment trusts are saying the same thing that the home builders are saying the same things that Home Depot is saying the same thing. So either all of these CEOs are lying to us, even though it is not in their best interest in every single industry across every single player to lie, or alternatively, the media is right and these guys, the media is like desperate to try to get some stories going. So that's how I feel about it. It drives me crazy a little bit because free press and the way that financial news is supposed to be independent and factual, and yet when I see things like this, I'm just like, please, come on, you know, whatever. But anyways, so just realize that's what's happening to home builders. Sorry to go off on a tangent there. Sometimes I just get very a certain way, but it is what it is. Consumer confidence, though, the fact that the consumer is still hanging in there is going to be an interesting thing. But that leads me to the fact that tomorrow we do get GDP. And I really want to remind, I specifically agree with a set of economists that define GDP as two negative quarters. But the fact is there are a lot of different ways to define GDP. And especially in this one particular moment in history, it's kind of important when you're talking to people, if this is something that you're very passionate about understanding, to really appreciate what they're using as a definition versus the textbook definition, because it really isn't quite a textbook definition versus what somebody else might be saying. So GDP currently, folks are thinking it's going to be down this quarter, which would be your 2 quarters. That said, they were talking about it this morning. I agree, but I think that the timing is really important, and I don't think people are caring enough about timing, that we will see a deflationary impact at some point, whether it's in the back half of the year or whether it's something else. It's hard to say. I would mention a couple of things. If you're expecting deflation in food and energy, that and you're aggressive on that stance, then you got bigger cojones than I have. I don't have cojones. I am a girl, so there is that. But like you're definitely bold and making a call, because I do think until you get through this summer and see how much more we're drawing down on inventory and how much Mother Nature just helps a girl out as far as like re-upping food related storage, it's just hard to say. Now, again, like I said, the other events that are happening this week, starting tomorrow, we start to see what's happening to the food supply in the United States and globally, because this is the USDA, I think, website that I pulled this off of, but there's a couple of different agencies, and typically they do kind of try to work together to discuss what's happening in grain stocks globally, so that the American farmer can have a sense for how to think about what's going on with his planting season. But we will start to get those data points Thursday and Friday, and then that'll give us a sense what's happening on food. Now, anyone that actually works in farming knows that it ain't over till it's over, and for these crops in particular, it ain't over till we get closer to fall. But July will give you some sense if there's a severe problem, which matters, and it matters because we've had droughts in the Midwest. So it's like not an insignificant thing to know if the farmers are already seeing a problem Thursday and Friday. So those things still to come, still could jostle this market, which is why every single time you see the VIX, I should just pull it up. Every single time you see the VIX come up for sale, like it went under 13. I'm using UVXY. So this, I know a lot of folks, David, you prefer the SIBO, which I also sometimes prefer. It's just that the other's a little bit more tradable. But when this baby tries to kiss 25, you want to go ahead and buy it through the summer, because it's just not. This is not. We're not through the volatility, my loves. We are not through the volatility in any way, shape, or form. So there's that. Inflation, again, this was from yesterday. I don't remember if I presented it. Oh, you know what? There's, I just want to remind you guys that historical contribution of oil price shocks to global inflation. Global inflation, meaning that it's a little different from any one country getting it. But you usually, like, if you look at the deflation that happened, this is where oil was pricing at the time. We came out of a really, really wonderful period of low oil prices. Even, even if because sometimes it's hard. COVID, obviously, gas prices very low, but realize that pre-COVID, gas prices very low is really the other way to think about it. I don't know another way to say it, but ever since pretty much just after 2012, we've had really, really low, beautiful gas prices and oil prices, which has helped us out a lot. So this is something that I think is sorely misunderstood, that the impact of oil supply, despite all the environmentalists out there who have a right to feel the way they feel. We got to find a solution to this, but currently this is where we're at. And, there's only so much capacity you can add. I don't know another way to say it. You're starting to see some news flow on that topic, but I don't think it's fully appreciated that no matter how hard these guys try to make up the demand for global supply, it's really going to have to come from, I think a couple of countries might be able to increase maybe another 2 million barrels, but that's really not a lot to compensate for the large amount of supply that Russia was doing. And also, by the way, just the flat increase in just demand as this GDP, as the world locks hands and tries to increase, growth coming out of the post-COVID period. Okay. The other big news flow item that I heard actually Kathy Wood talking about this morning, and I respect that woman in so many ways. She had a really intriguing way of thinking about the Nike inventories. I didn't necessarily agree with her so much, but I didn't necessarily disagree with her. And it really was this. This is, you always find, for those that are still trying to figure out how to find your way around the financial statements, inventory will always be in the balance sheet, and it will be updated each quarter as a snapshot. It's not necessary to compare it past too many quarters unless there's something really specific you're trying to discover. But currently, you can see that there was a 23% inventory build relative to last year. And she interpreted that as something that was a little concerning from a recession perspective, what have you. I think this one's a tough one to call. She also made the claim as well that she'd never seen anything like that, Walmart, Target, et cetera. That woman's smart and she could absolutely be right. Whereas a lot of times I'd be a lot bolder and just being like, she's wrong. In this case, no, you know what? This is a tough call. The way that I'm interpreting it is that last year, May 31st, 2021, all-time low, problematically low inventory across the globe. And a lot of that had to do with shutdowns in Asia. With Nike, it's a little bit different because they do have a tremendous amount of business overseas, particularly in China. So, the China business was a little bit slower because of the lockdowns, but that's something that China can undo like this by just unlocking itself. Let's call it what it is. In the US, we had crazy low because we still have the port issue, but it was even worse May of last year. And so I think it's possible that the street is being too aggressive in the way that they're thinking about this inventory build, because if you go back to the year previous and realize that the consumer wasn't as strong, you see a little bit of a different picture. And then you think about how much growth has gone on. And then you also think about the fact that this isn't, the inventory build is FIFO, right? So first in, first out. It's not LIFO usually. So this number is going to represent just a higher dollar value on the inventory to begin with, given inflation. So just roll out. I'm going to kind of, going into next quarter, be paying attention to whether or not this is being interpreted in a way that isn't fair to the companies. And if it is, it will produce a buying opportunity across retail if, in fact, the consumer is a lot stronger than the world is saying. So it's a lot of ifs. And so it does suggest that within retail, you might get some opportunities. The one that I actually like the best right this minute, I have to do some store checks. So if you're watching this video and you shop there all the time and you're telling me, let me know your experience. But the one that I actually quite like is Kohls, because when you do valuation on Kohls, store by store, what they're selling, you just end up with a really cheap retailer, and you end up with owners that have been very clear that they're happy to sell if they wish, just to get their valuation, because they're trading at low single digits EBITDA, EV to EBITDA, meaning there's not a lot of debt. And given what they're actually generating in cash, it's actually a decent situation. But I haven't had a chance to stop into a Kohls, and there aren't any Kohls in New York City. So hopefully before I leave Arizona, I'll be able to stop in on a Kohls and just see what's up. But if you're watching this and you've been to Kohls and you see nothing on sale, like I see at TJ Maxx, and inventory is not like squashed together like it is sometimes, let me know and post it down below. The other thing I just kind of want to mention that's a little bit crazy out there, it's affecting Freeport McMoran and also Newmont, is this Western ban on Russian gold. This thing is so stupid. I don't know another way to say it. A lot of people have said, like this article in Reuters, which I'm sure will make it through, it's largely symbolic. I mean, it's gold. It's not like you're scanning it to make sure it came from one place to the other. The whole reason, I mean, I get why they're banning Russian gold being mined out, but there's going to be countries, pretty much that map of countries that doesn't like us very much, that's going to have no problem taking that gold right from Russia, and then it becomes magically unpatriated gold. So this is just a load of silliness, and to the if anything, it's just going to drive up the price of gold, even though we're seeing kind of mixed reaction to it in the marketplace. A lot of people forget Freeport McMoran, they actually have a lot of gold. They mine gold and copper, not just copper. So it's always crazy to me that Newmont will rally and Freeport will not rally in the same way, or might even be down. So Freeport is the way I prefer to play it. FCX is the ticker on that. And then finally, I want to remind you guys of this one, because I may not be, I mean, like, there's a lot of people that know gaming better than me. I'm not gonna pretend like I'm the end all be all, but like, if I, there's a lot of haters of this acquisition where they just think, but notice with all of the rigmarole we're going through between Twitter and Elon, not a word has been said further other than, Microsoft just chilling out on the call saying like, yeah, we think that this will wrap very beautifully into Xbox. But some announcements have happened that I think people just are not paying attention to or do not understand strategically. I have been very clear on this purchase. This is a smart purchase on Microsoft's point of view. This absolutely is to help them. I mean, this is a very affordable buy for them relative to what their ambitions are in the gaming space. If you are confused at all that that this should be something you should take a look at, realize they're getting rid of the hardware for Xbox. And I think, to me, this is Microsoft's way of getting more headcount to enter the metaverse and what's going to happen in Web 3.0 across both their core enterprise business, by the way, not just gaming and consumer, but also to augment further what's going on in consumer. The way that I prefer to buy it, folks believe that this would close earliest end of year, potentially as late as first quarter of next year. So I would take a look at the March or April options and try to structure it as a calendar spread. What's that mean? Okay, a lot of mumbo jumbo. You just go into your options chain, know that the deal was done at 95. Let's say, like a lot of people do, if you look at the options, it does in fact look like there's plenty of people that thinks it closes by year end. Hence, you've got some plenty of liquidity, or you got some just look at where the volume is on options purchases in what we call it, in the January contract, okay, and that'll give you a sense for it. But if you want to just get farther back, you can do a calendar spread like this. Now, just as an example, realize first and foremost that these spreads are crazy wide, okay? So a lot of times, just with a little extra capital, something like that, I'll just throw it in there, and then if it gets hit, it does, awesome. If it doesn't get hit, fine. In other words, in these circumstances, I'm just purely being a liquidity provider. So if you do this right here, right now, the mid, let me see if I messed this up. Yeah, the mid on this spread. Ooh, I cut it out too short. It was the mid on this spread is $2.33, which it means that the other side of this is quite high, like $3 and change. So you could put it in for $2.30. Let's say you put it in for $2.33. This thing will trade 1 for 1 up to $95 after it crosses $97.50. And so then you collect something like $7.50, you paid $2.33. Your payout is 3 for 1. But this is how you might want to consider just taking a look and seeing if you can get it done. And you could do it all the way at 85, you could do it at 82, and subsequently you're just subtracting. All you're doing on these calendars is you're just subtracting from whatever the difference between 95 and the strike price you end up getting, and then you're adjusting for the cost. These are all debit spreads. Your max loss on this is $2.33 if you did it if you were able to get it off at $2.33. But this is just something you could do. If you think May, March seems a little aggressive, what if it slips into April? Fine, just keep going back until you feel comfortable with the payout and what you do. And then do yourself a limit order, because this market is going to be volatile. And what's really happening here every now and then is just that people need liquidity on whatever it is they own, and they're shaking out of it. So with that, I'll go ahead and hit the stop share button and take some questions. How's everybody doing today? Sunny and beautiful in Sedona, so I'm doing pretty good.
Hey May, how is Sedona?
Oh, it's so beautiful. I love this. This really definitely is one of my happy places. I'm so grateful that my best friend is happy to let me stay at her and crash at her pad every now and then and soak in the rays. But this is really one of my favorite places in the world.
Okay. GDP.
Mm-hmm.
Why was it bad in the first quarter?
I think things slowed down because we had little incident going on in Europe and people were a little freaked out. Plus the first quarter in general is going to be a little slower. You had China shut down. You still have some things at the ports. I mean, there's lots of reasons why. A lot of that slowdown was March though. War was declared February 22nd ish, plus or minus a day. And then war was imminent even before that. So you have a little bit of hey, let's just take a half a beat and see how it goes going on globally, so to speak.
Okay, because I think the economy seems pretty robust.
Yeah, I mean, in fair and square, like I said, on the consumer side, that one is a wild card. I can't. Some things I'm just like, for sure that's false. But right now, it's hard for me to know for sure. I think there's enough uncertainty where a lot of folks are dialing it back as relates to job postings. Do you know what I mean? Like there's still some people, legitimately people still need to hire for sure. But like some of my friends, they're like, look, I need at least this many people, but originally I had posted for this many people. They're not doing that anymore, where they're totally cool to take on an extra person that may or may not be productive. So like, for example, if you had 20 outstanding posts, probably in the last couple of months, because of inflation, because of a number of things, you took a look at the 20 posts and were like, all right, let's dial this back to 8 or something like that, such that we still have a need and a weakness in the job. Like we still have job growth and we still have a lot of folks, a lot of job openings, but when like it was last quarter. Does that make sense the way I'm saying it?
Well, yeah, I'm trying to relate it to GDP.
Oh, it relates to GDP because it indicates that the businesses are a little bit concerned. Will it affect this quarter? Hard to say. But will it affect next quarter? It does indicate that there's a bit of a slowdown. And relative to last year, remember last year, it was, let's get them into the door as fast as possible. So remember, GDP growth is relative to the previous year too. So we got some of that.
Okay, cool.
Hopefully that made sense. I don't know if it made sense. Any other questions?
No, I do not. Thank you. Great
Okay,
call.
no worries.
Call him Devin.
Oh yeah, Qualcomm. We didn't talk about Qualcomm. You reminded me this morning. Yeah, Qualcomm's a good company. They had crazy good growth, and this whole announcement that you were telling me about, where people are finally admitting that the Qualcomm chip in cell phone and mobile phones is just the right one.
Right.
Yeah. So high five for me.
High five.
No,
like
no, man, I had a question about
hey, what's up, Dietrich?
hey, how's it going, everyone? It may be a silly question, but it's
No,
related to
silly
Russia.
Yeah.
With the default issue and having the G7 intervening.
Oh, that's a big deal.
So how's that, in what ways would that affect us as far as the market wise?
Okay, on the good news side, Russian debt is very low relative to other things. So you're just going to have another round on the debt markets. See, most people I think had credit default swaps on it as early as January if they were actually bothering to do that business, or they were already cutting it down. I can't see any investment bank. I mean, most of them in the first quarter already said, "Hey, I'm going to take a donut on my default issue with respect to Russian debt." So like all your big banks, there may be some small ones, but I don't think so, because really the small banks don't do emerging markets debt. It's really the bigger banks that do it. And that would be like JP Morgan, and then on JP Morgan, Citi, et cetera. And then on the other side, it would be Goldman Sachs, Morgan Stanley. But Goldman Sachs, first of all, Goldman definitely took a donut on it. They were just, because I just know how Goldman behaves. There would be zero, and I think they said it too, but I'd have to double check on the first quarter call, not second quarter call. Okay. And I believe it was also stated in the JP Morgan call in the first quarter that they were going to take a donut on it as well and just move on. And that makes sense to me because during COVID, most people by last year had already released most of the excess reserves they took for the COVID issues that were going on. JP Morgan still had more to release, which is why the fourth quarter and first quarter synthetically looked better than some of the other banks. But the second quarter obviously started to show some issues as far as that goes. And in fairness, I was already a little bit concerned after the first. It doesn't matter. Point is that they had plenty of reserves that they hadn't released yet to take the zero on Russia. So I don't think this affects our banking system at all. Now, on the asset management side of the world, there may be some asset managers, but most of them, like if you do emerging market debt and you don't know how to do emerging market, like this is like, honestly, you're so basic. I'm sorry, I'm not being mean to anyone who's actually blowing up right now, but you're so basic if you don't, like, that's like, it's just, that would be so strange to me. I don't know who you would be at that point, like, sorry if I offended anyone. It's just,
No, thank you.
Russia has the money and wants to pay. They just, because of the SWIFT system and the sanctions, they cannot. So
Yeah.
not like they will not pay in 2 months, for example.
Yeah.
But they might not be allowed to pay for a long time. But if you're in EM debt,
that's
David is 100% right on all that. But as far as like how it'll impact any of us, it shouldn't. It shouldn't.
Okay. All right. Yeah, because that's why I read the
Why,
same
is someone
thing.
paying it? Is
No.
someone paying
Okay.
Let me
Because
know
I
if
was
they
just
are.
because I read over the other day, just briefly. I didn't read it in depth, but same thing with David.
Yeah.
What you said as well, May, as far as they do have the money, but they're not able to pay it all. So pretty much just you just brush it over and move on.
Yeah, I mean, I think I think the currency guys will probably eventually make out like bandits, and they're probably structuring whatever they're doing so that their payout scheme is like farther back, because at some point, unfortunately, depending on how it works in the geopolitics, certain things will resolve. I'm hoping that they resolve in a way that is, in line with value systems, but it's really hard to say. We try not to be political on this show. You know what I'm saying? I try not to be political. I think there's a lot of moving parts and stuff. So, but I think in the more exciting thing from a markets perspective right this minute is I do think that all of this news flow on the commodity side, I don't know why they're doing it. All it really does, it doesn't really hurt, unfortunately, the folks that they're trying to hurt. All it really does is create massive volatility in commodity markets. I wish they would stop, quite frankly, because there's enough issues with the commodities markets not to have this synthetic volatility created in it, which serves zero purpose to end in the conflict or in any way harming the powers that be, and it does a lot to actually hurt the consumers of various countries. I wish they'd stop, really, but my job is to report what I know about trading dynamics. It's not to have a world view that tries to influence the future, so to speak. You know, I'm just saying, powers that be, if you guys could maybe hire someone that's worked in the commodities market for some meaningful amount of time, that would really be appreciated. And it would probably help you end your conflict a lot faster without harming people. That's all I really have to say. I mean, to be fair. Like,
Yeah, that's very fair.
all you're really going to do is drive up the price of gold to someone who has gold right now and is using it to fuel exactly what you'd like him to not fuel. But anyway, sorry on that note, is there any other questions that'll get me out of speaking my mind on politics?
Let's stop recording and see what Dietrich needs.
Okay, super cool. Thanks, guys. Good luck in these markets.